Okay, well, good evening, everyone. I'm Stephen Moore, and I'm thrilled to welcome you to today's webinar. It's Need to Renew. What do I do? As a seasoned realtor here, leading a dedicated team in York Region, Durham Region, Peel Region, Kawartha Lakes, and kind of mostly East Toronto areas, really understand that the unique challenges of homeowners in these regions face, especially, well, everyone's facing right now with their ever-evolving landscape of real estate. Now, my team and I have found that over the last few months, the number one question our friends, family, and clients really is, my mortgage is renewing soon, so I'm not sure what to do, right? So each case is a little different, obviously, and everyone needs to take it seriously because it's going to really affect a lot of us. So today we're diving right into that topic, and it's on the minds of many homeowners. So mortgage renewals when the time of higher interest rates are here. So navigating this landscape requires kind of knowledge, strategy, and most importantly, the right guidance, right? So that's why we've teamed up with our expert in the mortgage world, someone with wealth of knowledge and experience to share with you. So I'm honored to introduce our co-host today, Rosanna Tantalo from Pineapple Mortgage. Rosanna brings a depth of understanding of our mortgage market that is truly invaluable. She'll be taking us through some intricacies of the current mortgage landscape and shedding light on the challenges faced by homeowners, and most importantly, providing some insights, some solutions, and to make your renewal process kind of as smooth as possible over the next couple of years. So without further ado, let's give a warm virtual welcome to Rosanna. Take it away, Rosanna.
Hi, Steve. Thank you for that introduction. Hi, everyone. Good evening. Thank you for joining us. As Steve mentioned, I'm just going to kind of get into, the nitty gritty of what everyone is facing come the next few years. We all know that mortgage rates have gone up since COVID, and those are challenges that, borrowers are facing upon renewal. So I'm just going to, give me 1 second, get into my slide deck. Perfect. So as Steve mentioned, the one question on everybody's mind is my mortgage is coming up for renewal. What do I do? So I'm just going to give you a little bit of information about myself, just so you know a little bit of my background. I'm a mortgage agent with the fastest growing mortgage brokerage in Canada and the only Canadian mortgage brokerage listed on the New York Stock Exchange, Pineapple Financial. That actually happened last week, I believe, where we became listed on the New York Stock Exchange. I've been in the industry for 7 years. Prior to working in mortgages, I was actually an early childhood educator. I have a great team around me in Pineapple with over 20 years of experience. So, if there's something I don't know, something I'm unsure of, I have that team of agents and, admin and underwriters to back me to get me the answers that work to find you a solution. Personalized service catered to each individual needs. Mortgages, the bones of a mortgage are pretty similar, but no two situations are alike. My situation is different than Steve's, is different than, Joe down the street. So my focus is always to get to know my clients, get to know their wants, get to know their needs, and find a solution that works best for them. Whether it's a short-term solution in the interim, just to kind of get through what we're going through, or planning for the long term as well. Um, I'm very relationship focused. I want to be that trusted broker to all my clients. I will touch base with you. I will provide you with saving opportunities during the term of your mortgage if they come up. I want you to come to me with any questions at any time. I want you to feel like my best friend. You can reach out to me at any time. As Steve mentioned, I'm also the mortgage agent, the go-to mortgage agent for the great realtors on the Realtors Collective team. I'm the in-house mortgage agent for Century 21 Leading Edge, and I do also work with some other real estate teams with different brokerages as well. Please feel free to stop me, Steve, if there's any questions, okay? So what are the current challenges borrowers are facing upon renewal? It's no surprise to anyone interest rates are higher than where we were during COVID. And at times, if it comes down to missing a more is paying your mortgage, majority of people are going to pay their mortgage. So we're seeing a lot of clients with some credit issues, but there are ways to manage these credit issues and kind of get you back on track. So I do a lot of credit counseling as well with my clients to make sure that their credit is where it should be for prime and optimal lenders to look at their file. Your credit score does determine the lender options that are available to you. So I'll get into a little bit more on credit as we go through the presentation as well. So factors affecting the interest rates. At the end of the day, it's inflation. The Bank of Canada sets a target inflation rate of 2%. The number one tool to fight inflation is increasing the interest rates. Now, the catch-22 here is higher mortgage interest rates actually impacts inflation and puts us far off of that 2% target, right? So we'll get into some graphics for you now. So shelter inflation affects the overall numbers. When they're looking at inflation and what's measuring inflation, how inflation is measured, they're actually looking at the mortgage interest. So as interest rates rise, more of your monthly payment is going to interest and less of your monthly payment is going to principal. So when they're using interest rates to measure how it's impacting inflation, they're looking at this line right here. And as you can see from Q1 of 2021 to Q4 of 2022, interest has gone up quite significantly. Now, we just received the numbers, the inflationary numbers for October, which was 3.1%. We are down from 3.8% in September, which is good news. We're heading in the right direction. June of last year, if I'm not mistaken, we were at 6.8%. So we have come down. Every time the Bank of Canada makes an interest rate increase to the prime rate, it takes about 12 to 18 months for it to run its cycle, right? So we're still not through a complete cycle of interest rates that are even happening this year. It's still going to take some time to work through. But again, we are headed in the right direction. Now, if you take a look right over here, you'll see that, mortgage inflationary numbers is about 1.6%. If we remove that 1.6% from our 3.1% inflationary rate right now, we're actually below our target inflation of 2%. We're at 1.5. So all signs seem to be leading to we are going to see interest rates start to come down sooner rather than later. Originally, it was going to be rates are going to be higher for longer. I don't necessarily think that's the case. And the next slide will kind of show you why. The people who are going to be seeing more of the payment shock are going to be those who are renewing in 2025, 2026. Those who received mortgage interest, got their mortgage in 2020, we're likely seeing, the sub 2% on fixed rates. That's not going to be the case on renewal. So if they continue to increase the interest rates, it's going to be a disaster. They're going to have to bring them down because people will not be able to afford the homes that they're in if that's the case, right? So I do believe that interest rates are going to come down sooner rather than later. Tiff Macklem, who's on the director, of the Bank of Canada, he actually made a comment yesterday that he believes that interest rates may be high enough to get our inflation to 2%. Now, again, that's not indicating that he's guaranteeing that they're going to pause the interest rate increases, but it's pretty. It leads to the picture that I think they're going to start pausing, maybe not necessarily reducing right away, but they are definitely going to put a pause, I think, on those increases for the Bank of Canada. So now we're just going to get into a fixed versus variable rate situation. So the 5-year fixed renewals are going to see an approximate increase of 2 to 3% in the rates upon renewal. Mortgage payments are actually going to be higher upon first renewal than they were at time of acquisition. Right? That's not usually the case. But because we have seen an increase in interest rates, that's kind of where we're sitting right now. However, let's take a look at this chart right here. If we look at a 40-year history, yes, we've been hearing that interest rates are sky high. And yes, they are higher than where we were during the rock bottom rates of COVID in comparison. Absolutely. Because during COVID, we were seeing, sometimes even sub 1% rates, right? 1.5%, a little bit 1.5, 1.89. So for sure, they're definitely higher than where we were during COVID. But let's take a look over in 2017, 2018, 2019. We were already heading in an upward trajectory. So had we never had COVID, had we never had a pandemic, would we have seen those super low rates? Probably not. We probably would have been where we are right now. Okay. Also, let's take a look at this bond yield. So the bond yield directly impacts the fixed rates. Now, for the last few weeks, we have seen the bond rate below 4%, which is great news. Again, we're heading in the right direction. We've already started to see our lender partners reduce the fixed rates on certain mortgage products. So again, we are heading in the right direction. Is it going to happen overnight? Absolutely not. Lenders tend to increase their interest rates quicker than they would decrease them. But all signs are pointing to we are starting to see decrease in the rates, which is great for borrowers coming upon renewal. Now let's get into the variable rate situation. There's two types of variable mortgages. There's an adjustable variable and there's a true variable. What I want to focus on right now is the true variable with a static monthly payment. And the reason for that is because anyone who was in a true variable rate mortgage would have likely hit what's called a trigger rate or a trigger point. So with a true variable rate mortgage, as the prime rate increases or decreases, your monthly payment remains the same. How it's distributed amongst principal and interest is different. So obviously, as the rate increases, more of your payment is going to interest, less is going to principal, and vice versa. Now, what happens when you hit a trigger rate is the entirety of your monthly payment. The trigger rate is actually a rate in which the entirety of your monthly interest payment is only covering the interest, which in essence, you're not paying any principal down. You're basically in an interest only mortgage. You're only paying the interest charge. What causes the problem now is the trigger point. So that's the next interest rate increase where your monthly payment is no longer even covering the interest. Whatever your monthly payment is not covering is getting added to what you owe at the end, leading to a negative amortization, right? So essentially, you're going to owe more upon renewal than you did when you first started your mortgage. So if there's anyone in a variable rate mortgage right now, may have likely hit this scenario. There's a few ways banks were dealing with this, and the banks that have true variables are CIBC, TD, and BMO. So if you had a mortgage with any of those three banks, you would likely have hit a trigger rate at some point. They were either contacting the clients to increase monthly payment to at least cover the interest portion of the payment. They were requesting lump sum payments, and in some cases, and in most cases, they're just adding it to the balance owed at the end, which is extending your amortization, which is called a negative amortization. So upon renewal, if your loan is supposed to be $500,000, but your payments weren't covering the interest, you now owe, let's just say, $550,000, and your amortization is now maybe at 40 years, 50 years. We have to bring all of that in line at time of renewal. So OSFI, which is the Office of Superintendents of Financial Institutions, they estimate that about 18% of mortgages had a fixed rate payment, fixed rate product. 70% of those holders have seen their amortization rise to 35 years or longer. By regulation, we have to bring the amortization back down. So I know some clients, some colleagues of mine, they're actually right now seeing their own amortizations at 60, 70 years. That's going to be a huge shock to a lot of borrowers that aren't expecting that, especially if your bank hasn't reached out to tell you that, or your lender hasn't reached out to tell you that. It's going to be a huge shock. But this is where the good news is. If you purchased a property in 2019 or 2020, your mortgage is coming up for renewal in 2024, 2025, you likely did a 5-year. That's why I'm saying that. The most popular term is a 5-year. Your property value has gone up, which means there's equity in your home. That simple fact alone means that there are options for you upon renewal, right? What we have to do is plan ahead. So typically your lender will give you a renewal option 3 to 4 months before renewal. We need to start looking at your options at least 8 months to a year before renewal, because we want to plan. Yes, rates are coming down. Are they going to come back down to the 2%? Probably not. So we have to plan for what is ahead of us. But because you have this equity in your property, there are ways to mitigate the increase in monthly payment. Reach out to your mortgage advisor, reach out to your mortgage agent, do a full review of your budget, a full financial review, see where we can cut costs. Let's run different scenarios to see what the payments will look like if rates were at 4% or if rates are at 5% at time of renewal. Also, we do have the option to hold rates for up to 120 days with lenders. So even if your lender is giving you an option, does not necessarily mean you have to go with that lender. And I will get into the solutions as we speak. Solution number 1, Switching your existing loan to a new lender. So with this option, you have to keep all terms of your loan the same. So the remaining mortgage balance, the remaining amortization. You do not need to stick with your existing lender at time of renewal. On average, actually your existing lender will charge you about 15 basis points higher than what is currently on the market. There's a couple of reasons they do this. A, because they know people get lazy or get complacent and don't shop around. So they take advantage of that, right? Um, B is they never want to offer you the best rate up front. They're banks at the end of the day, right? They are in the business of making money. This is where we need to assess your situation before your renewal comes up and hold those rates for you. So let's just say, for example, on renewal, your existing lender is quoting you a 5-year at 6.09%. Your loan amount is $500, 500,000, sorry, over a 25-year amortization. Your monthly payment is going to be $3,225. Now, switching to a new lender, you could probably get an interest rate right now, and again, these have come down slightly, on a 5-year of 594. Your monthly payment is going to be $45 cheaper if you were to go with this new lender. Now, $45 a month may not seem like a lot of money, but after 5 years, it's $2,700 that you could be using to something else. Paying credit card debts, if you have children, you're going to need money, right? So why give a bank any more money than they actually need? Now, in a lot of cases, the new lender will pay for the cost to switch the mortgage to them. In some cases, they won't. This is where we have to come in and assess what kind of mortgage product you're in. Keep in mind that if you bought a property with less than 20% down payment, with an original amortization of 25 years, you were in an insured mortgage. You can switch an insured mortgage from one lender to another without having to qualify on the stress test rate. All mortgages have to qualify on a stress test. So it's a contract rate plus 2%. If you were in a insured mortgage, you do not need to qualify on the stress tested rate. This gives you more options to move your mortgage over to a new lender. Originally, we were having to qualify all of these mortgages on a stress test. And again, that's another reason why lenders, your existing lenders, offer you a higher rate because it's harder for you to switch at that point. That is no longer the case. We do have options to switch and keep everything the same. Solution number 2, maybe let's look at extending your amortization. So with this option, you're not changing the outstanding balance of your loan. You're simply looking to extend the amortization of your loan, right? Back to its original. Now, the amortization is the length of time you have to pay your mortgage down to zero. So in most cases, that's a 25-year or 30-year to begin with. You know, in the past, we had 40-year, 45. That's no longer the case. If you were in a conventional mortgage where you had 20% down or more and a 30-year amortization, at time of renewal, you can extend back to a 30-year amortization. It'll reduce the monthly payment. If at time of purchase, you purchased with less than 20% down payment, had an amortization of 25 years. However, if the equity in your property has gone up, where the loan to value is less than 80%, or you've paid down enough principal of your loan, you do have the option to extend back to a 30-year. Again, is extending your amortization always the best? There's pros and cons to it. In this environment, it's a good idea simply because it'll provide the cash flow that everyone needs. If we can save a little bit of money on our mortgage and put that money to something else, that's what we do. It's a short-term solution, because what happens is when you're paying a mortgage over a longer period of time, essentially you're paying more interest. Now, let's just say we went with this option for a lot of clients upon renewal. You can see here in this graph, let's compare 20-year, 25-year, and 30 at 2%. Your monthly payment is going to be significantly higher on the 20-year amortization. You're going to keep less interest though. On the 30-year, your monthly payment is going to be significantly lower, right? More interest. Now, each lender gives you prepayment privileges. If you're comfortable making a slightly higher mortgage payment, you're in your right to do that as long as you don't exceed that prepayment privilege that the lender is providing you, right? But if by some chance your situation changes, you can always revert back to your lower payment on a 30-year amortization. So it's about assessing the pros and cons. Right now, it's a good short-term solution to helping with the cash flow. And again, at time of renewal upon, let's just say you took another 5-year term. After that next 5-year term is done, you can always revert back to a lower amortization. You don't have to stay with the amortization you're at as long as you can qualify.
Hey, Rosanna. Just a
Yeah,
quick question we want to take on while we're in that space there.
yeah.
The question of basically what is the name of the mortgage that you don't have to do the stress test and switch? So insured mortgage, I believe. So you can explain what
It's
insured.
an insured. Yeah. So an insured mortgage, if you bought a property with less than 20% down payment in 2019 or 2020, whenever you purchased your property, and you want to switch to a new lender, that new lender will not qualify you on the stress tested rate. They will qualify you on the contract rate. So let's just say the contract rate right now on a 5-year insured is 549. They will qualify you on the 549, not on the 7.49 that they're stress testing. Does that make sense?
Is that if my question, the follow-up question to
Yeah.
that, um, we're going to look at if your house is obviously worth more than it was in 2019 or 2020. So because they were on an insured mortgage at the beginning, they still get that case.
Yes.
Their value,
Yes.
it'd be more than 20%. It wouldn't be less than 20%, but they'd still be.
Yeah. So they'd still be able to do it as long as they didn't refinance in between the time of they purchase. So let's say they purchased in 2019, year 3 of their mortgage, they decided, hey, there's equity in my property. I need to tap into that. That is automatically an uninsured mortgage at that point. So that is null and void.
Okay.
Okay. I actually just did one for a client who purchased in 2015 and he was renewing from 2015 to today. He never refinanced his loan. I was actually able to switch him without having to qualify on contract rate. I mean, on stress tested rate.
A good hidden trick.
Pardon?
That's a good hidden trick.
A good hidden trick? Yes, it is. So
Like,
it was always in the guidelines, but it was always ignored until recently.
yeah. So we're gonna always
So
advise people if they don't want to do less than 20%, then just do 19. So you're insured, at least you're insured 19.5.
yes. Yeah, now you will have to pay the mortgage default insurance, but again, that's based on the percentage of your down payment as well. So if you're at the 19% down payment, the mortgage default insurance premium will be lower than if you were putting 5% down.
Yeah.
Yeah. So yeah, in some cases, and I've done that in the past too, it made more sense for my client to take an insured mortgage than an uninsured and just put that simply like 1% less, so the 19% down payment. Again, it's all based on personal situation, personal circumstances. We kind of assess the situation and determine what options work the best for the client. Now let's go into solution number 3, refinancing to cash manage. So with this option, we're looking to access the equity that is built up in your property to mitigate the increase in monthly mortgage payments due to increased rates. So let's take a look at this example we have over here. Your original mortgage started at a $500,000 loan, 25-year amortization. Your interest rate on a 5-year fixed was 3%. Your monthly payment would be $2,366.23. Now, at time of renewal, yes, your balance has gone down. Your balance is now just under $430,000. Your amortization is also decreased because you've finished paying off 5 years of your mortgage. However, you have it in your head that interest rates may start falling in 3 years. I can take advantage of a lower interest rate. I'm going to look at a three-year rate of 6.29%. Your monthly payment would now be $3,113.61. That's a monthly increase of just under $750. That's a lot of money. Over 3 years, that's $27,000. I don't know about you, but I don't necessarily have an extra $750 a month lying around in my bank account, especially in today's economy, right? So here's what we do. You have the equity in your property. Let's see if we can take advantage of that. Now, when we're talking about refinancing, obviously your income has to qualify. You have to be able to qualify. But again, more often than not, we can get it done. Let's just say, okay, in 3 years, $27,000. Let's look at increasing your loan amount by $27,000. We're extending your amortization an additional 10 years. So we're going back to the 30-year amortization. You still want to do a 3-year fixed rate. The rate on a 3-year right now is about 6.8%. That's a monthly payment of $2,933. So it's still higher than your original payment. $567 worth, but now we've accessed about $27,000 in equity that you can put away in a separate account and use that money to buffer yourself. You can still make your $2,300 payment and take out $567 from that savings account every month to cover your mortgage. We want to be able to cash manage through this. Are rates going to be high forever? No, they're starting to go down. Will they go down overnight? No. So let's get you through this rough time by accessing the equity that is in your property because it's there. Solution number 4, refinancing to consolidate higher interest debt. As I mentioned earlier in the presentation, everyone has had to rely on credit cards, lines of credit. Everything is just more expensive, right? Credit cards are sitting at between 10 and 23%. Lines of credit right now are sitting at 7.7% to 15%. 7.7, you're looking at a home equity line of credit, they're a little bit cheaper. Personal lines of credit are a little bit more expensive. You have the equity in your property to pay down your debt, pay it off into one manageable mortgage payment. So you're not having to worry about paying off 3 credit cards, paying the minimum because that's all you can afford right now. Let's clear that debt off. Put everything into your mortgage payment. It'll make it easier. I've done this for clients in the past. You also have to realize that when you're at max utilization on credit cards, lines of credit, your credit score will drop. The last thing you want to do is have your credit score negatively impacted because it impacts lender options that are available to you. The lower your credit score, the less options we have for you, or the more expensive options that we have. So I think it was 2020. I had a client who had about 100K in debt. She was maxed on all of her forms of credit. She just couldn't manage, and she admitted to me it was personal. Not that she couldn't manage it. She just wanted, she'd planned a few trips that she probably shouldn't have planned, and she just got herself into a situation. And sometimes it happens. But what we did, her credit score was below the minimum for an A lender, so your big banks, your monoline lenders. What I did was I refinanced her, paid off all debt. We put her into a 1-year term with a B lender. B lenders are great options. They allow you to qualify for a little bit more. It's a short-term solution to get you out of a sticky situation. We were able to repair her credit score during that 1 year, and I constantly checked in with her. I checked in with her every month. We did a financial check of where her credit was at every month to make sure that at the end of that year, we could get her off of the B and transfer over to an A. And that's exactly what we did. We need to keep your credit score as high as possible. 680 plus is what A lenders look for. So if you're on maximum utilization on credit and you're only able to pay down the interest only payments every month, your credit score will begin to drop. It's not a good situation to be in. And again, because we have all this equity in your property, let's tap into that. Let's take care of your credit so that it's in good standing. Let's eliminate the stress you have of, your mortgage payment and 3 credit card payments and a car payment and a line of credit payment. Anything we can do to eliminate stress is what we will do. Solutions continued. So solution number 5, again, there's equity in your property. Let's take advantage of it. Accessing the equity in your property to maybe finish your basement, renovate the basement, add a self-contained rental unit that can bring in about $1,500 a month. That'll help you with your monthly mortgage payment. And again, to finish a basement, you don't need to spend an extravagant amount of money. $40,000, do some nice flooring, some IKEA counter, IKEA kitchen. You don't have to go, Wolf appliances and anything like that. It's just to generate income. You can use that equity to build, a garden suite, a laneway house. Those are becoming more popular, especially in Toronto. We're seeing a lot more of that. Lenders have become a lot more open to lending on those. Again, you'd have to check with your municipality on their restrictions for that, but that's another option to generate income. People are building these little laneway houses, charging $2,500 a month in rent. That money is going directly to them to help them with their expenses. There's options. Adding that separate laneway house, finishing your basement is going to increase your property value. You can have these realtors help you find a great tenant. They will vet all your tenants for you. There are options for you guys. We have to just assess what option works best for each individual client's needs. Now, we're going to discuss move up buying and why waiting, or the question of do I wait or do I not wait? Renewal time is a great time to consider upsizing or even downsizing because typically upon renewal, there's no penalties to break your mortgage. Your contract is essentially done. Now, the demand in move up buyers is based on the amount of equity in their home. So if you see this graph right here, this chart, everybody has amassed a huge amount of equity from January 19, if they purchased in 2019 to 2023, you can see property values have gone up 79% in Toronto Centre, 75% in Vaughan, 67% in Halton Hills, 83% in Brock. You know, there's equity in the property, right? The equity in the property means you sell, you have a higher down payment for a bigger property. And in all honesty, mortgage property values have come down a little bit, right? From our peak in 2022. It's going to be cheaper for you to get into a property now versus waiting until interest rates drop. What we do know and what history has shown us, and even earlier this year when the Bank of Canada slightly paused their interest rate hikes for I think it was 2 months in a row, consumer sentiment changes instantly. As soon as interest rates start to drop, people come out of the woodwork. What happens in Toronto, in GTA, in Ontario, we have a supply and demand issue. There are not enough properties for the amount of people who need to buy. We have new immigrants coming in, 500,000 people a year. We don't have enough property. So as interest rates start to go down, people are going to start bidding wars again. Bidding wars are going to push prices back up. It's going to cost you more to get into a property. So this chart here, what it's going to show you is, so CREA, the Canadian Real Estate Association, does a quarterly projection of where they feel prices are going to go to. And they're also using an an average of what the big banks are feeling that the interest rates may come down to. Now, you'll see here in August 2023, the average price was 650,000. Let's say we went with a 5-year discounted rate of 6.05%. The down payment, if we were going with a 20% down payment, you would have needed is $130,028. Closing costs are approximately, $13,000, $13,300. Upfront costs for down payment and closing costs, $143,328. Your mortgage amount is $520,112. Your monthly mortgage payment is $3,343.18. Now let's look at what happens when the rates decrease. Now, again, these are conservative numbers that they're using. The conservative number of a price growth, I think this is about 6.2%. I think that's fairly conservative. Typically, we go up a lot quicker comparison to the last slide. In a 5-year time, that was about 13% increase, let's just say for Brampton every year in value. So let's just say the rates go down 80 basis points to 5.25%. You are going to need a higher down payment to get into that property. So about $8,155 more for down payment. Closing costs are also going to increase. Closing costs are based on the purchase price of the property as well as the location of the property. There's a provincial and municipal land transfer tax if you purchase in Toronto. If you purchase outside of Toronto, there's only a provincial land transfer tax. So closing costs are going to increase by approximately $800. The total increase is about just under $9,000. Now, your mortgage will also be $32,000 more. Okay? Monthly payment is going to be $3,293. So yes, the monthly payment is about $50 cheaper a month. However, if you look at it over a 5-year term, you're still out of pocket $6,000. It's still going to cost you more with a lower interest rate to get into a property if you wait. Now, there's situations where you can't, you just have to wait. Like if you don't have enough job security, you have to wait. You need to wait. If you need a cosigner and you don't have one, then you need to wait. If you don't have the necessary down payment, you need to wait. That's not the case for most people who are looking to upsize if they bought in 2019 because there is equity in the property. But there are situations where it's unavoidable. You just have to wait. If you're waiting until interest rates drop, historically, that tends to be a little bit more risky. It tends to cost more, even though the interest rates are lower, the cost to get in is higher. And again, as interest rates drop, and as we continue to see them drop, we just give a 5-year average, 5-year fixed rate. It tends to be the most popular term. By no means do you have to take a 5-year rate. If you think rates are going to be lower in 2 or 3 years, take a 2 or 3 year fixed rate, or even a variable. A lot of people are jumping back on the variable train because they are anticipating that the Bank of Canada will hold steady and then start to decrease mid 2024. and we're expecting to see decreases in fixed and variable by mid 2024 or Q2, sorry, of 2024. So again, it's assessing your situation. A lot of my clients this year took a 5-year fixed. A lot of my clients took a 3-year fixed. Did I get a lot of clients asking for a variable or adjustable rate mortgage? No. Am I getting a lot of them asking for it now? Yes. Because historically, variable mortgages outperform fixed. Now, how to prep for your renewal. First of all, I would recommend that you book a time in my calendar and you can scan this QR code over here so that we can go over your unique situation. As I mentioned at the beginning, the bones of a mortgage are the same. No two people have the same situation that they're in. Let's figure out what we can do to get you comfortable with what is to come. Secondly, get all your property documents together. Property tax statements, current mortgage statements. If you pay maintenance fees, get those documents together so that we have accurate figures. If you own more than one property, we need those documents for all properties that you own, including lease agreements. Gather your income documents. Look for a letter of employment. Ask your employer for a letter of employment. Get your most recent pay stubs, 2-year T4s. T1 generals and notice of assessments are more for if you're self-employed. And put together a list of your expenses. This is where we'll go through what you spend on a monthly basis, your needs versus your wants. So you need groceries, you need, you need clothing for your children. You have a mortgage payment. Do you need to get Starbucks every day? Probably not. Let's see where we can cut some costs to make this time a little bit more manageable. And that's it. I know we went through it really quickly. We wanted to leave some time for questions, but as I mentioned, I can put the QR code back up, book a time in my calendar. I think they're set to half-an-hour time slots. If we need to take a little bit longer, I'm more than happy to extend the call time for sure. Steve?
I put it there too on your presentation. So
perfect. Yes. Yeah. So here's our contact information. And the QR code's there again.
So it's a free plan to prepare your mortgage for your mortgage renewal, right, Rosanna? So no cost.
Yes, absolutely. No cost, no obligation. Absolutely no obligation to use me. I would give you the options. If you feel more comfortable with your bank, by all means. But again, the bank is not always the best solution.
Yeah. Okay, a couple questions here for you.
Yeah.
So what factors?
Can I get out of the presentation?
Yeah, sure. Well, you can keep the scan code up. What factors do I consider when deciding between a fixed rate and variable rate mortgage for my renewal? That's one.
So right now it comes down, at the end of the day, it always comes down to personal preference. Me personally, I always chose a fixed rate mortgage. I just like the stability of it. I like knowing what my monthly payments are. However, in 2022, I refinanced my property to access some of the equity. I decided to go with a variable adjustable because historically being in this business, I know that variable interest rates outperform fixed. We were also going on, the Bank of Canada saying interest rates aren't going to increase that quickly. That wasn't the case. So it comes down to risk tolerance, right? Have I seen my monthly payments increase because I'm on an adjustable variable? I have. So I'm experiencing the worst of it throughout the increases. Will I benefit once the rates start going down? Yes. Was I able to feel comfortable with that potential risk of taking an adjustable variable? Yes, I was. If you're not comfortable with taking that risk, then choose a fixed. And again, you don't have to go with a 5-year fixed. If we anticipate and are starting to see that rates are going to start coming down in Q2 of next year, again, are they going to come down super quick? We don't know. More likely than not, no, they're going to come down fairly slowly. But again, if we anticipate that in 3 years, they're going to be back down to, like, let's just say the 4.5%, you don't really want to lock into a 5-year fixed, because to break a 5-year fixed is going to cost you more money than breaking a 3-year fixed if you had to break your mortgage. Then take the fixed. But it always comes down to personal preference and each individual situation. There's pros and cons to both.
Yeah, I think every situation is based on the risk tolerance level of that individual, right? Just so
100%. And like I said, I had a lot of clients taking a 5-year fix, and a lot of this year, because Even if they believed that the rates were going to drop in about 3 years, because they were first-time home buyers, the 5 years is always lower in terms of rate. It's the most popular rate, so that's where you're going to see most popular term. Sorry, so that's where you're going to see the lower rate. They needed that slightly lower rate to help them qualify for a little bit more. They were comfortable with making that decision. Is it the best decision for everyone? No. Some people don't have that qualification issue, so they were able to take a shorter term that's slightly higher in the interest rate and feel comfortable with it, knowing that they could potentially take advantage of lower rates sooner.
Right. Okay, another question for you.
Mhm.
I think this is related to on renewal time, so it's a quick answer, but are there
Yeah.
any penalties or fees associated with breaking my mortgage lender or moving away from my mortgage lender or from that agreement to pursue a better rate elsewhere?
Upon renewal, no, your contract is done with them.
Okay.
So if you have a mortgage with TD that's up for renewal in April and you want to switch your mortgage to, let's just say, MCAP, which is one of the top monoline lenders in Canada, if you do it upon renewal, there is no penalty to break. We can reach out to your current lender and say, what are my early renewal options? If, let's just say, TD says to you, we can give you a 3-year at 7%, I can say, well, I have MCAP offering a 6.59, for example, on a 5-year. I'm sorry, on a 3-year. Let's lock that rate in because we can hold it for 4 months. If rates drop in that 4 months, guess what? We get those lower rates. If rates have gone up in those 4 months, we get the rate that's being held. So it's never too early to plan ahead. The last thing you want to do is wait until a month before renewal, 2 weeks before renewal. It limits options, right? Let's look at everything as quickly as we can. Again, planning 12 months in advance isn't a bad thing. We can secure rate holds as rates decrease. And if they don't decrease and they stay steady, at least we've created a plan to kind of make you comfortable with what is coming, right? You got to start planning ahead. Gone are the times where, hey, I know in renewal time, my rate is going to be 2%. That's not the case. Your rate is always going to fluctuate. And I say this to all my clients, you are married to your mortgage, you are dating your rate. So let's date around, shop around for the best rate. There's no harm. And at the end of the day, if there isn't a better rate and if your current lender can do better and offer to match the rate, I would advise you to stay with that lender. 100%. My job is to make sure you are taken care of and I do what is in your best interest. And I have told clients, stay with your lender because there's nothing cheaper right now.
Can we combine some of these options?
Solution number 3, accessing equity to cash manage and maybe taking a little bit of extra equity to pay down debt or make that basement unit rentable. Those are what you can combine, right? Option number 1, the straight switch, is just the straight switch of your mortgage.
Yeah.
You're not changing the balance or the amortization. It's literally just a straight switch over. And option number 2 would be fairly similar. So yeah, you can combine if you wanted to take out a little bit of extra to have as a reserve fund, an emergency fund, but maybe an extra 20K to finish your basement, we can definitely do that.
Okay, great. One other question here is what steps can I take to improve my credit score before renewing my mortgage to secure a better rate?
Okay. Credit utilization makes up about, sorry, my light went off. Credit utilization makes up about 35% of how your credit score is actually calculated. If you have let's just say a credit card with a limit of $10,000, ideally you want to keep the outstanding balance at any time under 35%. Now, again, is that always possible? No, it's not. Try your very best. 50%, I would say, is kind of the max. More as you go above that 50% threshold, credit score is going to start dropping. Payment history makes up about 30% of how your credit score is calculated. Even if you can only make the interest-only monthly payment, do that. Try not to be late and try not to miss a payment. Okay? It's going to impact your credit score. Reduce the number of hard checks that you get on your credit. If you have credit that's been active for a long period of time, even if you're not using it, don't close older credit accounts. You want to keep those open. If they're in good standing, longevity of your credit makes a difference, but what you really want to focus on is utilization and payment history. That makes up the majority of how your credit score is actually calculated. Keeping those balances as low as possible and making those payments, even if it's only the interest only payment. That's what you can do. That's what you do. But at least make the payment and try not to be late. And we can go into, if you book a call, we'll go into analyzing where your credit score is currently at and how we fix, like, what should be paid off first. Should your line of credit or your credit card? We'll assess which is best.
Perfect. Okay, great. Yeah,
Any other questions?
Questions we have at the moment. So that was.
I think there's another one that just popped up in the Q&A.
Oh, I'm ready to book a call. So.
Oh. Oh, hi, Eric. I'll book a call with you anytime. Yeah.
Okay, great.
Book a call, guys. It's free. It's free. Again, there's no obligation. If you feel more comfortable with your current lender, with your current bank, by all means. My job is just to give you the solutions, knowing that you have options. The last thing we want is for people to feel that interest rates are high. I don't have any options. That's not true. There is always an option. And again, it could be a short-term B. For like that one client, I consolidated all her debt because her credit score was below the minimum threshold for an A lender. It was a 1 year, and then I moved her straight over to that A lender the following year, right? It may even be a private. And again, in this environment, that's not necessarily a bad thing. Short-term solutions to get you back to where you need to be.
Yeah. So if you're 3 months behind or 3 months away or 6 months away or 1 month away or a year away or a year and a half away or 2 years away, just book a call. Try to figure out where the plan can be, and your plan can be short, it can be long, right? So it's about getting ahead of it and being proactive, because things are going to happen, right? So
yeah. And again, if you're considering moving up, I can assess what the proceeds of your sale are going to look like.
yeah.
The realtors on the Realtors Collective team can give you an idea of what prices are going in the location you want. We have a team available to you guys at any time. They will take your call at any time, answer your emails. I will do the same.
Yeah.
I often work until midnight most nights. Am I going to take a call at midnight? No, but I'll probably answer an email.
Yeah.
But
some people on this call might be in the position where I've helped a few people recently where and it's an option, is that they're downsizing, and they've been in their home for quite a bit of time, and is it the best time to sell right now? No, but it's a great time to buy. So it's
exactly
the one and half a dozen of the other, and it allows them to eliminate their mortgage completely and find their new home and not even have to worry about the renewal of rates, because now they're mortgage free. So a few people do that over the last few months. So that's a big play, and you might want to consider that if you're in that position too. So,
and again, you're never going to make, we're not in a situation where sellers are going to want to sell at the same time buyers want to buy. Like, it's just, that's not how it happens. Buyers want to buy right now because property values have decreased since the peak of 2022. Yeah. So I'm going to say since the peak, because again, if you saw that graph, that chart, there's equity in your property. If you bought in 2019, your property has not depreciated. It has gone up. Okay. Yeah. So there's money there. There's money for you to access. Now, if anyone on this call knows anyone over 55 who still has a mortgage, we could look into a reverse mortgage for that individual. There's options for them too. A lot of the time, seniors still have mortgages but are living on a pension income. It makes it hard to make those payments. A reverse mortgage is geared to seniors to help them maintain a lifestyle that they've become accustomed to and eliminate the stress of having to worry about a mortgage payment. Yeah. They have equity in their property.
A lot of seniors don't know this, and the cost of living for them has gone up. In most cases, they're into more, maybe their drug plan doesn't cover certain things, or they've got, there's more health issues with them and they have to spend more money. Plus inflation is crazy with food and everything else. So it's see more and more, unfortunately, seniors going back to work and they have to. So they're really
exactly their pensions aren't going up. Like your OAS and your CPP isn't going to go up.
No.
Right? Our pay is really not going to go up as quickly as inflation has brought the cost.
Yeah. Some people on this call might have parents that need to be helped with that. And, you think reverse mortgage is a great solution to a
It's a
lot of
great solution for seniors.
people.
There's a misconception where the bank is going to take your house. That
Yeah.
is not the case. The bank will not lend more than 50% of the value of the property so that there's always equity in it, right? There's always, and because they're dealing with seniors, they have to be very careful, right? There's a standard that they have to hold. So they will not over leverage that individual. They cap what they can lend out to seniors. I just did one recently, reverse. They're great options. There's always that misconception the bank is going to take my house. I'm not going to have a house. That's not the case. And we can go through the numbers.
Yeah. Okay, great. So yeah,
Oh,
any condition at all, reach out to Rosanna here. She's got solutions for a lot of things. So I don't think we have
yes, I
any.
try.
Yeah.
Well,
I always try to stump
when
you.
you
So.
yeah, when you oh, Eric had a question. When you switch lenders, in which case do you have to requalify? When you're looking to increase the loan amount, well, you have to requalify for every switch. It's just whether or not they're going to stress test it or not. When you want to increase the loan amount, obviously they got to make sure you can income qualify. Your credit is where it needs to be to qualify with them. Debt load, obviously higher debt load, less you would qualify for. But yeah, you always have to requalify if you're switching lenders.
Yeah. So getting your credit in order and getting your documents in order. And another thing too, I just want to mention, might be some people on the call with this too, is obviously tax season's not too far away for a lot of us, and people that are self-employed, let's say. Self-employed people put a lot of things on expenses. But you never know. That might not be the right thing to do in this case where you need to qualify for a better mortgage with a different lender. So getting ahead of this before you do your taxes as a self-employed is super important. You need to create that plan because you may have put yourself in a position where you don't have an option if you do your taxes before you figure out what your renewal plan is. So
And we
that's,
can go through all of that. Like
yeah.
I would go through all of that. And again, there's different options for self-employed, and lenders look at self-employed income differently. Whether it's an A lender and a monoline like a big bank, they're going to look at it one way. A B lender is going to look at it a completely different way. So
Yeah.
let's see what makes the most sense.
Yeah. So there's lots of factors here to making your decision smart, and a lot of different things you need to consider, and what can you write off and what things that are going to increase, lower your taxes, but also increase your power to be able to hold that or renew in that new mortgage, right? So a lot of moving parts here. So
Steve, when is a good time to buy or to move?
Oh, the best time to move is when you're ready to move. So it's really dependent on the person, and we move when we feel like it's a good time to move for us, right? So trying to time the market is very tricky, and what go up must come down, and what goes down must come up. You're always buying in a market where maybe you're buying where it's hard to buy, but then it's easy to sell. But then if you're in a market where it's easy to buy, then it's hard to sell. It's 6 of one and half a dozen of the other. So trying to time it is really hard. You need to buy when you need to buy, right? And that's
As long as you are, yeah, as long as you are comfortable with your monthly payment
yeah.
and you can qualify, you're good.
First time home buyers, if you're a first time home buyer, you should be really figuring it out how to do it now. So because prices are only going to go up. There is a pent up demand. I talk to many people a day. They're waiting to buy, and a lot of people are waiting. So as soon as the Bank of Canada decides to lower rates and the media gets behind that, and we see it all over the news, it's going to start, and then it will just roll, right? And it's like a big elastic band. There's a lot of tension in the market right now and a lot of pent up buyers. So we're going to see them come back really quick. So if you are considering to sell, if you are considering buying, right now is a good time to get an idea of what you can afford, but also be educated on the market. So when you are ready to go, you can pull the trigger. You're not there fumbling around for a few months trying to figure out what type of home that I really need for my family. That's part of the journey, but you get that piece done early, so you have the ability to pull the trigger when the prices and the time is right for you. So now is a great time to shop. And you'll be ahead of the curve when you're ahead of the curve, you do better. So
Yeah, and as I mentioned
long
earlier,
answer, but there you go.
earlier this year, when the Bank of Canada just held rates steady for 2 months, we saw consumers' sentiment change. It wasn't even a decrease; it was just a hold steady, and we
Yep,
saw a little surge in the market,
that's
right?
right.
So as soon as rates start coming down, trust me, guys, that demand is going to go right up because it's it's just a sense of normalcy, comfort. Okay, rates are coming down. Now's a good time. But again, supply and demand, we do not have enough supply for the amount of demand.
No.
Inevitably, there's going to be bidding wars again. Prices are going to go back up.
Yep. Guaranteed. Guaranteed, unfortunately. So yeah, I think that's all of our questions.
Perfect. Great.
Yep. So,
Okay.
and with that, so we've come to an end of our webinar and need to renew.
Thanks,
What do I
guys.
do? So I hope you found today's insights kind of valuable, and now you're more equipped with the knowledge and strategies to make an informed decision about your upcoming mortgage renewal. Obviously, a big thank you to our co-host Rosanna Tantalo here from Pineapple Mortgage,
Thanks, guys.
sharing her expertise and helping us navigate this kind of complex landscape. But obviously, what you need to do is take advantage of Rosanna's free mortgage renewal assessment. Doesn't have to happen today or tomorrow, but it should happen before you renew and anytime before. Remember, whether you're in New York region, Durham, Peel, Kawartha, Lakes, Cottage Country, or even East Toronto, our team is here to support you with your real estate journey. So feel free to reach out and with any further questions or assistance you may need. But wishing everyone all the best in your homeownership endeavors. And thank you for joining us tonight, and have a wonderful evening. So
Thank you, everyone. Have a great evening.
All right.
Thanks.
Bye-bye.